You make a great salary. On paper, you are wealthy, but by the end of the month, your bank account hits zero. Every rupee you earn is immediately claimed by your housing loans, your par loans, and credit card minimums. We are going to build a step-by-step mathematical roadmap to clear your high-interest debt. You will do this using exactly what you earn right now, no side hustles and no waiting for a promotion. The immediate instinct is to look for a new job with a higher package, but adding more money to a broken system only creates more expensive debt. If your spending scales with your income, a 50% raise just results in 50% larger EMIs. Before we start, you need to pull up 3 exact numbers. First, your total monthly in-hand income after deductions. Second, your absolute bare minimum survival expenses, food, utilities, and mandatory travel. Third, write down every single active debt, including the exact interest rate for each. Putting these numbers on paper forces you to deal with your present reality. Once you stop relying on an imaginary future bonus to save you, you can actually fix the math. Step 1. Log into your brokerage accounts and immediately pause all your non-mandatory investments, including your active mutual fund SIPs. There is zero mathematical sense in investing while holding unsecured debt. The stock market might give you a 12% return over a long period, but personal loans and credit cards drain your wealth at 15 to 36%. You are losing money faster than you can grow it. Now calculate your free surplus. Take your total income and subtract your survival expenses. Then add those paused SIPs directly into that remaining cash. This combined number is your free surplus. Standard financial advice tells you to always stay invested. But right now, temporarily hoarding this cash is the only mathematically sound way to plug the high-interest leaks draining your net worth. Step 2. Take 100% of that newly calculated free surplus and direct it straight into a standard, easily accessible fixed deposit. Your specific target for this deposit is exactly 3 months of your mandatory survival expenses. Do not touch your debt until this progress bar is completely full. You will feel a strong psychological urge to skip this step. Holding cash feels unproductive when you have loans hanging over your head. If a medical emergency hits or you face a sudden layoff and you have zero cash in the bank, you will be forced to swipe a credit card. One bad month will wipe out all your repayment progress and force you right back into high-interest debt. This emergency fund is not an investment you are trying to optimize for high returns. It is a strict defensive shield required to protect the integrity of your debt payoff plan. Step 3. Look at your itemized debt list and isolate the highest interest offenders. These are your personal loans and credit cards, which usually charge anywhere from 12 to 36%. Pay the absolute minimum required on your lower interest loans. Then take your entire free surplus and slam it directly into the highest interest debt. Once cleared, add its monthly EMI to your free surplus. Your cash weapon swells up, creating a larger attack force. Check your banking interface every time a principal balance drops to zero. Seeing the math work in real time builds the psychological momentum you need to keep going. There is one absolute rule here. Once you clear a credit card balance, you must never use it to spend money you do not already have in the bank. Aggressively destroying your high-interest debt first creates compounding financial momentum. Every time you close an account, you free up a progressively larger chunk of cash for the following month. Step 4. You are now left with your final category of debts: low-interest, long-duration commitments, like a 9% home loan. You do not need to throw your entire monthly surplus at these specific loans. Instead, you will use a specific 2-part timeline hack. Part 1. Commit to making exactly 1 extra EMI payment at the end of every calendar year. Part 2. Manually instruct your bank to increase your monthly EMI amount by exactly 10% every year. This chart shows exactly how powerful this is. On the left is a standard 25-year home loan timeline. By making 1 extra payment a year and increasing your EMI by 10%, the timeline shrinks to 10 years. You save massive amounts of interest the bank expected to collect. Restructuring low-interest debt with incremental step-ups saves you decades of payments and millions in interest, and it achieves this without requiring a drastic, painful downgrade to your daily lifestyle. Follow these 4 steps, and you reach the finish line. You transition from drowning in EMIs to complete debt freedom. Every rupee of your monthly surplus finally belongs entirely to you. Now you switch to playing offense. Your immediate next move is to use your retained surplus to secure comprehensive term and health insurance, protecting your family from unexpected financial shocks. Then, you finally restart those paused SIPs. You can confidently invest your cash flow into indexed and niched funds, knowing your wealth is fully protected. True financial freedom isn't achieved by hoping for a massive future income bump. It is achieved by mathematically engineering your current reality today.